Hey everybody, I'm Mike DeSepoli and welcome to Ask the Advisor 68. So today I want to talk about a problem that plagues 79% of all individual investors. And this one particular problem is leading them to underperform the market year in and year out. And obviously that's costing them money. So we want to talk about allowing your emotions to interfere with your investment strategy, and more importantly, how you can avoid allowing that to happen. You know, look, we understand money is something you work very hard for, and it's tough not to be emotional about it, particularly when you risk your capital in the equity markets and you're not seeing the results that you desire. However, that is sometimes the most vulnerable point when people face themselves in a decision between do I go, do I stay, do I buy, do I sell? And this type of emotional pull, research indicates, actually contributes to a 4% differential per year for an investor that has no plan and acts on emotion versus one that values fundamentals, strategy, and has a guided approach. So how can you avoid letting emotions cloud your investment strategy and ultimately being detrimental to your returns? Rule number one, you cannot love stocks. Stocks will not love you back. We see this a lot of time in the case of perhaps an inheritance where you inherited stock that your parents used to own and you just cannot see yourself parting ways with that stock due to the emotional ties. That is a prime example of allowing your emotions to get in the way of a fundamental sound decision. I understand your parents left you that stock, but your parents would not want to see that stock trade down to zero and lose all the money that they worked hard for. So that's rule number one. Don't love your stocks. They will never love you back. Rule number two, do not forget how markets work. Okay, long-term investors have been handsomely rewarded for quite some time by investing in equity markets. And yet those returns don't come without a price. That price that we pay is volatility and risk to our capital. Obviously, we want to be able to quantify that risk. We want to keep it manageable and sustainable, but nonetheless, we can't expect equity returns without some of the risks and volatility that go along with equity markets. Number three, don't lose your sense of history. Okay, over the last 35 years, the markets have averaged one drawdown per year of about 14%. Now, while that probably sounds pretty scary, 27 of those 35 years, the markets finished positive. So put it in context, keep the history around the markets, understand the fact that markets can fall and still finish the year higher. And number four, don't focus on the minute-to-minute gyrations in the market. There's a 47% chance that if you log into your account every minute of every day, you will see a loss, because on a minute-to-minute basis, the markets trade down more than they trade up. However, on a year-by-year basis, if you only checked your account once per year, you'd likely see a gain 75% of the time. So again, that's just an example that exacerbates the problem that is viewing your accounts too often. Obviously, technology is great, but it keeps us so attached and so in tune with some of our market investments that it can cause those emotional reactions to be overcharged and, of course, lead you down the roads of peril. So again, guys, these are just a couple ways that you can keep emotions out of your investment strategy. 79% of investors will not heed this advice and will continue to make decisions on a day-by-day, week-by-week basis based upon how their emotions feel at that time. That's not a successful strategy for any investor, and here at our firm, we want to make sure investors get the most return on life possible. Thanks so much, guys, for keeping up with our videos. We'll see you back next week for episode 69.